All right, we're going to get rolling.
They helped create an economy that was completely addicted to cheap money.
You need to buy savings bonds or something. You need to be way, way, way out of this space.
I subscribe to Miss Piggy's rule of money management. Always manage to have more money, you know what I mean?
It wasn't but 2 years ago that everybody was saying China's economy was going to be bigger than that of the United States. It's gone in the exact opposite direction.
So we're going to jump right in.
Welcome to VRIC Media, the most trusted voice in metals and mining. And I'm here with Rick Rule. Rick, it's great to see you again. Thanks for coming back on the channel.
Jay, it's a pleasure to be on your channel. And by the way, congratulations on the great growth of your channel. It's wonderful to watch somebody who works hard be rewarded by the market.
No, I appreciate that. And it's fun. Yeah. And I'm going to see you soon in person at the VRIC, live on stage, Vancouver, January 19th and 20th. And this is going to be a blast. I'm always like super jacked about our agenda. Like every year, it's what I spend the most time on and what I get most excited about. This year's an absolute barn burner. Like our main hall is just chock block with amazing panel debates, panel discussions, fireside chats. I think I'm working you pretty hard, Rick. I've got you on like 6 different features, but it'll be a lot of fun.
Well, I don't have too many years left, Jay, so, work away.
Squeeze the orange till I got it.
In the prelude to this discussion, I was reminiscing over the fact that I was at the first VRIC. In fact, I collaborated with your father in causing it to occur.
Yeah.
It's come a long way under him and farther under you. So congratulations. I think it's going to be a great show, and I look forward to participating.
Appreciate that. So today I want to cover a lot of ground with you. I want to, we're going to go kind of commodity by commodity. I'm going to share my thoughts and thesis, but I want to get yours, obviously. And so we'll walk through copper, which now is a metal that seemingly everybody is bullish on. So I'm going to make an assumption about how you feel. We're going to talk about nuclear and uranium. I want to talk about gold, of course. But where I want to start is actually on the oil and gas market, because I don't cover this market very extensively on my show, but I know I believe you're very invested in it right now. And so could we start there and we can just jump in with your thesis, what you're seeing and what you're doing?
Well, for Canadian investors and speculators in particular, today was an auspicious day. Your Prime Minister, a man who decided that there was no business case for Canadian natural gas, despite the fact that all of your customers thought there was a business case, has decided to pursue other employment opportunities, depending on how your country chooses to replace him. By the way, I'm not one who believe that Americans should lecture other people on politics. That's a very different topic. Depending on how you choose to replace him, I think what happens today is an important game changer for the Canadian oil and gas business. There have been obstacles that were legislative, which is to say de jure obstacles, which could change. But there were de facto obstacles too. And I think those obstacles are gone, or at least have the potential to be gone, depending on how Canada chooses to replace her prime minister. Mm-hmm. And the equity prices around the Canadian oil and gas sector have been ridiculously cheap, even considering the constrained outlook for both Canadian oil and gas. So I think that Canadian equity investors in oil and gas can look forward to a double bounce, which is to say that Canadian oil and gas becomes attractively priced relative to its pricing, and the pricing changes as a consequence of a change in government. Mm-hmm. This, I think, will potentially be doubly true because of a change in U.S. administration. Mm-hmm. If both the Canadian federal government and the U.S. government decide to remove the constraints, the bottlenecks around the transmission of Canadian natural gas to European markets, both through the eastern seaboard of Canada, but also through the eastern seaboard of the United States. And if the constraints around the Keystone Pipeline, moving Canadian heavy oil, particularly sour crude, from constrained Canadian markets to really desperate U.S. Gulf Coast markets, The benefits that accrue to investors in Canadian oil and gas industry over the next 5 years should be substantial. Don't look necessarily for gains in 3 months or 4 months. Understand that markets take a long time to work. But something very, very profound happened today. And I hope that your listeners study that change and study how to take advantage of it.
Okay, so that's interesting. So therefore, you'd be looking at production companies and maybe transport companies and shipping companies, on the logistics end and the production end. Is that right?
Yeah, I mean, for most investors, they don't need to get too fancy with this.
Right.
If the whole industry reprices, what you learn in extractive industries is that these repricings are dramatic. And you don't need to go to the riskiest, most leveraged, highest alpha names. If you just go to the best names in the space, you're going to do fine. Choose 7 or 8 extraordinarily high quality names, own them for 5 years, enjoy the dividends, and watch your wealth change positively. This is really, really, really simple stuff. The only thing that can really get in the way of this is a synchronized global recession or depression that changes demand for energy on a global basis. I'm not saying that's going to happen or it's not going to happen.
Right.
What I'm trying to say is that nobody's smart enough to know if it will happen. So you pay attention to bets where the odds are decidedly on your side. And the odds changed today.
Now, could an acceleration of U.S. production under Trump or these constraints being removed in Canada or both causing a surge of new production come to the market provide a counterpoint that you'll be looking out for down the road, Rick?
I don't think for Canadian heavy crude, no. The U.S. Gulf Coast refining industry was changed 25 or 30 years ago to take advantage of very low-priced, sour, high-sulfur oil from Mexico and Venezuela. Domestic policies in those countries have constrained their ability to produce by about 75%. The best way to provide the feedstock for those refineries is Canadian crude. The only thing that stands between Canadian crude and a market desperate for it is politics. And the politics may have changed in both countries. Does this change things in 6 months, 3 months? No. Change affects financial markets over 5 years, but this is profound change. Similarly, let's look at the gross arithmetic around Canadian natural gas, where your prime minister didn't see a business case. The gate price for Alberta crude, the AECO price, has hovered around $2 per million BTU for a very long time. That same gas, delivered as liquefied natural gas in Shanghai or Tokyo or Rotterdam, commanded about $13 per million BTU Canadian. And it takes about $3 Canadian to get it there. So add 2 to 3, you get 5. Takes $5 to deliver a million BTU of Alberta gas to Rotterdam, where it sells for 13. And your prime minister didn't see a business case for it. Interesting circumstance. The ability to access that market, which is beginning to happen anyway, as a consequence of liquefied natural gas facilities on the Pacific coast in British Columbia. But the ability to access European markets, either ultimately through liquefied facilities on the eastern Canadian Atlantic Ocean, or more probably through U.S. infrastructure, through U.S. export facilities, really becomes a game changer for the Canadian natural gas industry. An important game changer. Again, don't look for a market response in 3 months or 6 months. Look for a market response that is truly a magnificent response over 5 years.
Okay, got it. Now, maybe my last question on this would be, do you have any thoughts on Trump's ambitions to, go back to a drill baby drill campaign? There's been maybe some regulatory constraints as well, but are there also geological constraints now at this point? If you look at the Marcellus and the Bakken and the Eagle Ford, maybe have already rolled over, maybe the Permian too. What do you think about that, Rick?
The U.S. domestic bases have challenges at this commodity price with this cost of capital with existing technologies.
Okay.
There are three aspects to the market in addition to regulation that matter. I suspect that the regulatory constraints are really truly a thing of the past, at least for a couple of years. At today's commodity prices, with today's technology and today's cost of capital, it's estimated in the Permian Basin, the basin that I know the best, that we've already drilled 75 or 80% of our A locations. If technology improves, then we skate more B locations into A locations. If the pricing goes up, we skate more B locations into A locations. If the cost of capital falls, we skate more B locations into A locations. But with the current cocktail, if you will, of geology, technology, cost of capital, and commodity prices, I would suspect that in the most important domestic basin, which is to say the Permian Basin, that we're probably 2.5 years away from drilling out our best inventory. Marcellus is probably still a wide open gas basin, but that still leaves lots of room for Canadian gas. The traditional markets that you enjoyed into the U.S. Northeast and Midwest are increasingly going to be serviced by domestic U.S. gas. And without an expansion of the Canadian natural gas transmission infrastructure to the east of Canada, larger amounts of Atlantic seaboard and Canadian demand will in fact be met by U.S. gas. There will be a bit of a gas swap. That notwithstanding, the demand for fossil fuels on a global basis continues to grow at the same time that the global fossil fuel industry is underinvesting to the tune of $1 billion a day in sustaining capital investments. This deferral of sustaining capital investments in a capital-intensive business means 2 or 3 years from now that global production, absent luck, will be in decline. And Canada will potentially, with the political constraints removed, be a swing producer that will be important to global energy production and, of course, very important to the Canadian domestic economy.
So when you say $365 billion annual shortfall of sustainable capital investments, this is the cash required to maintain current production rates?
That's correct.
Is that it? Okay.
That's correct.
Right. Which in the right environment is Canada's opportunity, which I completely agree with you when we have the right governance, which is a governance that just clears the way for the provinces to conduct business. Canada can thrive. And there's no need to become a 51st state. You know, we are rich in natural resources with very few people. The natural resource to person ratio is fantastic in this country when managed properly.
And people underestimate the value of human capital in Canada around extractive industries. Canada punches way above its weight. Even in oil and gas, which has been deliberately sabotaged by your federal government. But it's important to note that Canada exports technology and human resources as well as natural resources. Canada punches way, way, way above its weight in mineral exploration and in mining finance, and punches way above its weight in terms of human resources around oil and gas too. It amused me that your government decided to subsidize, as an example, electric vehicle manufacturing or other economic activities where Canada had no definable competitive advantage, and ignore the industries where you had world-class respect for your human capital.
Yeah. It's such a it's mind-boggling. I agree with you. And general life advice says play to your strengths, right? That's a good strategy most of the time. We haven't been doing that.
Countries are making moves on the geopolitical chessboard. New alliances are forming and new enemies are being made. If you're at all curious how you can position your investment portfolio to turn chaos into opportunity, you can't afford to miss the Vancouver Resource Investment Conference. January 19th and 20th at the Vancouver Convention Center. Visit cambridgehouse.com for tickets today.
Okay, so I want to pivot a little bit to copper. Everybody in the world is a copper bull right now, and let me just run through a couple things I'm thinking about, and then I want to know what you think about that, and then get your thoughts. So the forecasts today are typically built off of renewable energy demand in the future, electric vehicles. Maybe AI is going to cause another boom for infrastructure requirements, and this is going to send copper demand through the roof. The other point would be, yes, but we're probably headed towards some kind of a globally coordinated recession, and that's going to melt a lot of this demand away. And which is going to occur, I have no idea. I have no ability to forecast that. But what we can do is look at the last 50 years of copper supply and demand and see if there's any trends, and there is, from 1970, 80, 90, 2000, 2010, 2020, you'll see that we increase copper demand on a very consistent basis when you average it over the decade, 4 to 6 million metric tons per decade, starting from 3 to 4 metric tons in the 70s to 24 million metric tons today. What's interesting about that to me is that if we look through that 50-year time period, we saw all of the stuff that might happen in the future. We saw massive technological innovation. We saw the dawn of the internet, of the personal computer, smart tech, cell phones, all of this stuff. We also saw massive crashes in 87, .com, 2008. So anything that might happen in the future, it has happened in the last 50 years, yet the demand curve is really consistent. And so when I hear people say, we're going to suddenly double demand by 2035, I don't know, maybe, right? Now, we haven't invested in the production, so you'll see production on pace decade after decade from 70, 80, 90. It's right in step until about 2015. And then production kind of sits at 19 million metric tons when demand keeps going up to now 24. So the mouth is opening, but I don't know as wide as a lot of people like to think. But what are your thoughts, Rick?
3 comments. Demand is anybody's guess. And the risk has to come from, as you would suggest, a synchronized global recession. Will we have one? Will we not have one? I don't know. I'm not an economist. I'm a lender. Supply, though, is baked in the cake. And supply is in trouble. Your viewers would do well to think about copper supply by looking at me. 71 years of age, fat, balding, past his prime. I'm a copper mine. The big copper mines in the world, Chuquicamata, 120 years of age. Bingham Canyon, 160 years of age. Highland Valley, 70 years of age. Grasberg, 45 years of age. It's not as though you stand on a pit wall and throw in water and fertilizer and grow more copper. That's not the way it works. We need to replace 1 Bingham Canyon a year to handle current demand, never mind demand's growth. Now let's talk about demand growth. Those of us in the West, particularly people your age, focus on new demand, electric vehicles, or AI. They're all important. That's not the most important part of demand, though. The demand that kicked off this millennium was the urbanization of China. Deng Xiaoping saying to be rich is glorious. Jay, there are 1 billion people on Earth, 1 billion, that have no access to primary electricity at all. They want to live like you do. Moving that electricity to them, allowing them in their house to utilize it. This is an incredible demand. And it's the right thing to do. We've done a great job as humankind raising the material living standards of the poor over the last 40 years. We've lifted 2.5 billion people from dire poverty and made them merely poor. Is there more to do? Yes. But there's still a job to do with the billion poorest of the poor. And we're going to do it over the next 20 years. As poor people get more spending power, Jay, the thing that delivers utility to them is not some little gizmo from Apple or some service. Poor people eat better food. Their method of transportation goes from barefoot to sneakers, to a bicycle, to a 50cc motorcycle, to a Toyota Hilux. All of this requires stuff. And the stuff argument, in particular the copper argument, is also about lifting up the poorest of the poor. That's one of the reasons why I feel so bullish about the copper space. Could this panacea be derailed by a global recession? Absolutely. You can have lower production if you have lower consumption and the price falls. What I do know is that if you look out over the next 5 years, you have inexorable production declines at this price point. There's zero doubt about that. People talk about the move in the copper price from $3 to $4. They forget about the decline in the purchasing power of the US dollar over that point in time. I would suggest that relative to the cost of building a copper mine and the inputs required to operate a copper mine, that the copper price is unchanged, or at least the margins are unchanged. Building a big copper mine today, a porphyry copper mine, is an $8 billion exercise or a $10 billion exercise, assuming that you started today. But you don't get to start today. One great example would be the Resolution mine in Arizona, discovered 32, 33 years ago. It's a great deposit, over 1 billion tons of 1.5% copper. To put that in context, 3 times the average mine grade worldwide. It's in a great place for a copper mine. It's next to a highway, next to a town full of copper miners, and between 2 other copper mines. And this mine has now been in the permitting stage for 26 years. To finance this thing and build it will take a decade when they get permitted. The supply side of copper is what people are forgetting.
Okay, I love what you did there, because you kind of threw out the whole AI, maybe EVs, maybe renewables, maybe.
I think that's all true, but everybody, especially everybody your age, and everybody from your demographic and my demographic, looks at it.
Yeah,
we look at AI; it excites us. We look at electric vehicles. You know, electric vehicles are not much of a market demand in a place like Zimbabwe. And we have prologue around this. The commodities boom that at least your father so enjoyed in the decade 2000 to 2010 was all about the urbanization of China. And this is going to be replicated in fits and starts around 1 billion people worldwide. This is a mega trend.
Okay, so a couple questions off of that. First of all, I like how you just brought that back to the copper bet is effectively, are you still long human ingenuity and progress? Because that's been a pretty good bet for the last couple thousand years. Probably will be in the future. There's 2 questions. So using the Resolution mine as an example, it's been in permitting for 26 years. Once it gets permitted, we can still expect another decade to build it and $8 to $10 billion. That seems like something that has to change. Like how do we proceed forward when the process of acquiring the ingredients we need is that inefficient? And it hasn't really been an issue until now. I mean, we haven't had to deal with that. It's been fine that this mine's been in permitting for 26 years because we've met demand to a degree. We're not going to for very much longer. So I imagine some massive disruption needs to occur, will occur in some way, but what do you think?
From an investor's point of view and an industry point of view, you probably need to seek out more favorable jurisdictions and hope that they stay favorable.
Right. Yeah.
You know, Chile probably could have, at the time that that deposit was discovered, permitted it in 2 years. Which means that it would have been in production 2 decades ago. Chile is becoming less friendly, more restrictive, but still, compared to Arizona, it's a lovely jurisdiction. You have to go where you find the copper, of course, but looking for copper or developing copper in jurisdictions that are more permissive is one way out. If you're looking for copper in the United States, I think it's important that you look for copper on private land, not land that's under federal or state jurisdiction. That's an important thing to do. In other words, obviate as much regulatory constraint as you can. It's interesting that some of the jurisdictions that are regarded as being the riskiest for copper, if you look at the true regulatory constraints around those jurisdictions, turn out to be the least risky. I know that once, as an example, Ivanhoe Mines had reached the feasibility stage on the Kamoa-Kakula deposits in Congo, that the time to permitting was about 18 months. So is Congo more or less risky on a net present value basis than Arizona? It's true that the chances of being shot in Arizona or getting malaria in Arizona are less. But think about the net present value of a $500 million investment project where free cash flow is delayed for 26 years.
Yeah.
Think about an appropriate discount rate, 5%, 8%. The truth is, it doesn't matter. The net present value of that $500 million delayed by 26 years is zero.
Yeah. Okay. I mean, okay. I'll leave that. Yeah. I mean, I feel inclined to say that there's got to be some intelligent disruption to the regulatory process in developed countries like Canada and the US. It doesn't mean it's going to happen. Maybe that's just the optimist in me. But I look at this math and it's like, this isn't sustainable for the next 10 years. It might have been for the last 10, last 20.
I think,
it isn't anymore.
I think at the top, the narrative changes.
Yeah.
I think the election of Trump had less to do with the fact that people wanted a convicted felon as president than they wanted the narrative around the economy to change. I think, too, that the excusing of the Laurentian elite around the form of Justin Trudeau suggests the same thing. An example would be there's another wonderful copper deposit in the United States in central Alaska, the Antler deposit, that has widespread popular support in Alaska. And former President Biden decided unilaterally to oppose an access road to that deposit. I think that type of de facto, not de jure, but de facto opposition to resource development in the United States is over for a while. I think there's I think there's popular consensus and increasingly federal political consensus around a more permissive regulatory environment in both jurisdictions than you would have seen 3 or 4 years ago.
Yeah, I agree with that. Okay, so last thread I want to pull on in the copper conversation would be, you mentioned the commodity boom from 2000 to 2010 was largely fueled by the urbanization of China. Was it not also fueled by massive Chinese stimulus programs? And, would we need to see something like that from an emerging economy to really stimulate? And China's maybe beginning to do something similar today with their recent stimulus, but it's not quite on the same scale. What do you think?
Oh, what you say is important. What will matter is whether the Chinese have the ability to afford it. The Chinese were able to afford that stimulus because they sold us stuff.
Right.
One could say that the ultimate stimulus in China was Walmart or Amazon. And will the global consumer continue to afford China the margins that will allow China to continue the pace of growth? This is going to sound enormously racist, but I'm a huge believer in the Chinese people. I'm a huge believer in a culture that encourages thrift and that encourages education. I'm amazed at the success of the Chinese diaspora globally. Of course, I witnessed it firsthand in Vancouver. And I hope that the Chinese government continues to allow the Chinese people to progress with some measure of freedom. The ability that the Chinese now have with the capital that they've accumulated over the last 50 years to grow their economy internally is extremely attractive. I'm nervous about a society like China where 10 or 15,000 people, the Politburo, determine the wants and needs of the Chinese people away from the market. I'm nervous about the feedback mechanism. I'm nervous about the direction of Chinese stimulus rather than allowing Chinese people to work hard, save, invest and spend as they see fit. The proclivity of the Chinese state and the US state and the Canadian state to have an elite, elected or otherwise, that is allowed to express the will of the people has always seemed to me to be a highly risky proposition. And that I would suggest is a problem for China, given that the population involved in decision making is an even more constrained fraction of the whole than it would be in either Canada or the United States.
Okay. Do you think that but you're probably looking further than just China for this urbanization trend. You're probably looking at the whole South Pacific, South Asia, India. Yeah.
I am.
Yeah.
Particularly Africa.
Yeah. Right. Okay.
Africa has a reputation as a basket case. By the way, a deserved reputation.
Yeah.
But the Africa that we face today, relative to the Africa that we faced when I first started investing there 40 years ago, is very different. There is a very educated, very productive middle class in Africa. If you go to places like Lagos and you look at the skyline, you will understand that today's Africa is very different than the Africa that existed when I was your age.
Sure.
And I think Africa is going to have an absolute demographic boom. What could go wrong? Lots. The proclivity for coup, the incredible apparent corruption. But I think that probably to a lesser degree, but to an important degree, that you are going to see absolute demographic booms in young cultures that have access, as an example, through the internet, to education and to paradigm that wasn't available to them 20 years ago or 30 years ago. It's going to take place in, Malawi and Zimbabwe and Bolivia and Laos. I think it's going to be messy, but I think it's going to take place in Bangladesh. I think it's going to take place in Pakistan. I think it's going to take place in Sudan. It doesn't mean that there won't be incredible friction between my generation and your generation in those countries. But your generation is going to win if for no other reason than my generation is going to die.
Right.
And sadly for my generation, that'll be very beneficial for these people.
All right. I like it. So let's move to nuclear uranium now. Rick, I've seen you standing at my podium for a decade, telling the audience either the lights go out or the price goes up. 2018, I think $17 per pound, right? And look what's occurred since then, volatility, but so generally speaking, one trend up and to the right. What are your thoughts? So, when you see that, a lot of people who were bears turn to bulls. Now there's a consensus bet. What are your thoughts today on the uranium market?
Oh, big topic. It's amazing to me, first of all, how the popular sentiment around uranium has changed. In my own country, 4 or 5 years ago, I would have been politically vilified for making the case about uranium.
Mm-hmm.
Now the morons want to subsidize me.
Right.
The truth is, Jay, I felt cleaner when they hated me than I do now when they want to subsidize me. But I'm old, and I would prefer to be unclean and safe.
Sure.
I think the world's woken up to some extent. I think that the popular demand for affordable baseload power that doesn't generate carbon has overcome some of the phobia around nuclear that was engendered earlier. So I think there's been a change in the sociology and the politics of uranium, which is good. I think also that what I said would happen at your conference over time has happened. The cure for low prices is low prices. That's the point I made from the podium. At $17 a pound, either the price of uranium went up to 60 or the lights would go up. Those were the two changes. Well, it didn't go to 60. It went to 100, backed off to 60, came up to 75. This is not an unacceptable price for the uranium business. What changes things, Jay, is the changing structure of the market. We are going very, very rapidly from a market where the uranium price is determined overnight in the spot market to one where contracts can be struck between producers and consumers for 5 years, 10 years, 15 years, or 20 years. What this means is that unlike any other commodity in the world, a small producer or a developer can sign contracts with investment grade counterparties and literally take those contracts to the bank. You can determine for 15 years how much material you can sell and what price you can sell it for. An old fat lazy analyst like Rick Rule doesn't have to try to anticipate what the uranium price will be 15 years from now. I can just look at the price that Southern Company, Tokyo Electric Power, China General Nuclear, or Duke Power is prepared to pay for the material 15 years from now and how much they're willing to consume, and construct a net present value model based on fact. This is a game changer, an absolute game changer. 10 years ago, somebody who discovered a nice deposit in Canada but didn't have an investment grade balance sheet knew that they had to advance the project to a certain stage and they had to sell it. And probably with Canadian politics, they had to sell it to Cameco. If you have an auction with one bidder, you don't have an auction. Today, that same producer can go to Cameco, can go to Westinghouse, and Westinghouse will build the mine for them on a fixed price contract. And they can take the off-put and sell it to Ontario Hydro or Southern Company or Duke Power for prices that are locked in for as long as they want with an investment grade counterparty, which means that they can build the deposit, if not on balance sheet, with construction financing that's secured by the purchase contracts. Doesn't mean necessarily that they want to do this, but it does mean that there's a competitive process.
Right.
And that is a changing fact in the uranium market that not 1 in 1,000 speculators has identified or cared about. And it's extremely important.
So a couple of things I want to pull on there. Firstly, I just want to point the audience to the consistency of the thesis. When we were talking about copper, we came back to the long bet on human ingenuity and progress. When we got to uranium, Rick was saying, look, at $17 per pound, we're either going to go to 60 per pound or the lights are going to go out. That's the same bet. Long human ingenuity and progress. It's the same thesis, different commodity, same outcome. Uranium shot up to 100, corrected to 75. So pulling on what you just shared there, Rick, you said 99.9% of speculators miss this opportunity. How should they play it? Where should they begin looking for opportunity in the uranium sector right now? Where are you looking for opportunity?
Well, I think the top of the feeding chain is usually the best place for people who are risk averse and don't want to do too much work. There's only one name at the top of the feeding chain. That's Cameco. Your risk there is that in buying Westinghouse, they've diversified into a business that they don't know as well as they know mining. Can they run a big engineering business? The answer to that is I don't know. I'm willing to bet that they can, because I think that, among other things, they have the good sense to leave most of those people alone and let them build plants. But Cameco has material that they regard as waste that many juniors would regard as resource.
Right.
And for most people, the beta involved in the potential outperformance of nuclear power relative to other investment opportunities in energy is such that over 5 years, people can shut their eyes and own Cameco.
Right.
They might not feel happy about it this June, but they're going to feel delighted in 2030, unless whoever you elect is worse than the guy that you deposed. For people who are willing to do more risk, coming down the quality trail, there are probably 10 or 12 deposits in the world that are economic at $70 uranium, if that $70 uranium can be contracted out for long enough to amortize the construction loan.
Mm-hmm.
This is really, truly a game changer. And identifying not the pretenders, not people who are looking for uranium, but rather people who have developable uranium that have the ability to finance it into the term market. This is the part of the uranium business that not one speculator in 1,000 is focused on. And starting to focus on this is where I think the certain money in the next 5 years will be made.
And do you see any downside at all to these long-term contracts suppressing the upside of a producer? Because
Two things. Do I see any threats? The first threat would be a replay of Fukushima, Chernobyl, or 3 Mile Island,
sure,
which is to say a plant failure. A plant failure would set the uranium business back 10 or 15 years. And even I don't have that much patience. Never mind time left on Earth.
Sure.
A second challenge is that many investors haven't learned that limiting their downside is just as important as maintaining their upside. And so you have a whole bunch of investors who look at optionality in uranium and say, why on earth would I accept $75 when I could get 100? The truth is they may or may not get the 100.
Yeah.
But if you contract for 60 or 65% of your production at $75, you put yourself in an ability to produce, and maybe you can get the 100 for the extra 25.
Yeah.
Whatever the answer to that is, Jay, at 71, almost 72, I've learned if you take away almost all of my downside, you can have some of my upside. I'm happy with that trade.
Yeah.
And I think we have the ability in 10 or 12 names worldwide of taking away damn near all of our downside.
That's a really excellent point. I'm glad you mentioned that the importance of limiting your downside is greater, I would even argue, than capturing your upside, because that's how you stay at the table. And duration is what wins in this game. It's staying at the table, right? Sticking around. Yeah, not getting wiped out. So the first concern then would be a plant failure on par with something big that's happened in the past. That could put a 10, 15-year delay on something which is longer than you have the patience to wait for. I just got to ask, because I kind of feel like jury's out for me on that one, although I feel like the technology has moved the right direction. And the inland facilities are building, the molten salt reactors are built different than, and if I've got this right, you'd know better than I would. The reason we didn't start using molten salt reactors inland was because the first maybe scaled use of nuclear reactors was in submarines. And so access to water to cool the plant made sense. It was logical. Whereas in a molten salts, water actually causes an explosion, which is why we've built this style of reactor going forward, but molten salt's probably the better option. Is that at all accurate?
Yeah, I mean, even conventional plants worked on cooling and steam.
Yeah,
more water dependent.
Right.
The second thing is, at least with regards to Chernobyl, that there were deliberate trade-offs between safety and capital cost. Shevardnadze, who you may recall, maybe not, maybe you're too young, was in fact Ukrainian, said that the Politburo decision was that Ukrainians were cheaper than concrete. And they were willing to take the containment risk because they didn't want the upfront capital cost associated with that level of power production. Those decisions are much less likely to be repeated today.
Right.
As you point out, the ascent of humankind, the ascent of technology, stuff gets better and better and better. The reemergence of North American participation in power plant technology, which has really been a Japanese and more lately a Chinese area of expertise, I think will accelerate the pace of change. There's nothing like competition and repetition. So I think that the level of technological sophistication around nuclear power generation has come a long way in 25 years, but I think the pace of change is increasing, not decreasing.
Mm-hmm. Agreed. Okay. So when it comes to the uranium sector, there's maybe 10 to 12 deposits globally that have the resource that could get taken to market. They're not in the exploration business of maybe one day. What they need to do is secure contracts under today's prices, secure cash flow, construction expenses, and move forward.
Correct.
Okay.
Correct.
Yeah.
You know, when I look at these companies from the point of view of a project financier, a lender, which is, JIM, if you take away the price risk, I can be much more generous
Sure.
in terms of my cost of capital.
Yeah.
The non-investment grade resource issuer seldom acknowledges that their cost of capital around project finance, off-balance sheet project finance, is characteristically between 15 and 17%. It doesn't read that.
Mm-hmm.
It feels like it.
Right.
And if you take away the price risk and you hold other interest rates steady, that cost of capital probably falls from 17% to 10% or 11%.
Mm-hmm.
That's
Mm-hmm.
enormous.
Yeah. Yeah, it certainly is. Okay. So I want to move to maybe the last commodity that we'll cover today, which is gold. We were having coffee just a week and a half ago in Vancouver, and you very quickly sort of outlined your bull case for gold, and you related to 1970s seeing Americans drive up to the Vancouver Stock Exchange building, double park outside to try to get inside and buy some gold equity shares, which I thought was just absolutely hilarious. But let me ask this question to begin. I'm very bullish on the gold sector, and that tends to make me bullish on gold equities. I have been in this industry since 2011, right? So the majority of my career has been capital leaving the gold sector, right? And not coming back. And I wonder if the venture market today, if the investment environment in Canada today is built in such a way that would facilitate a resurgence in that equity market. We can see the gold price run, and we're seeing that, right? But that may or may not relate to a similar environment we saw in the 70s and the 2000s. And what's your take, Rick? Prove me wrong.
Somewhere in the middle, I guess.
Yeah.
I think that the reason that the capital has left the gold industry doesn't have so much to do with the gold price. Remember that the gold price in the year 2000 done very well.
Yeah.
It has to do with the performance of the industry. I'll personalize it, Jay. I would rather see your conference have 100 very high quality exhibitors paying you more per booth
Mm-hmm.
than 250 exhibitors, some of whom are marginal. I think if you look at the length and breadth of the junior mining industry, what you'll see is mostly flotsam and jetsam. I think that if there are 3,000 public juniors worldwide and you merge them all into one company, Junior Explorer Co., that company in a very good year would lose $2 billion. And in a bad year, it would lose $10 billion. So what should investors pay for a business that loses $2 billion a year? Should they pay 8 times losses? 12 times losses? In a buoyant market, should they pay 15 times losses? No. Your conference and people like me need to do a better job of teaching investors how to separate the wheat from the chaff. If we had better corporate performance, we would have lower cost of equity. Simple fact. Now, I believe that a rising tide, unfortunately, will float all ships. I believe that the good, the bad, and the ugly will all go up. We haven't done a good enough job of killing the cockroaches in a bad market, and they will proliferate. Make no mistake, Jay, I don't own gold because I think it might go from 2,700 to 3,000. I own gold because I'm afraid it's going to go to 10,000 or 12,000. I hope it doesn't happen, although I own a lot of it. The set of circumstances that causes the gold business to do very well are a set of circumstances that are almost invariably unpleasant in other parts of your life. And the other parts of my life are extremely pleasant. I don't want them to change. But let's look at the world's reserve currency. Let's look at the US dollar. The guarantor, if you will, the US government, has $130 trillion in liability. 30 trillion on balance sheet, 100 trillion off balance sheet. Social Security, Medicare, Medicaid. To put that in context, that $130 trillion debt is offset by the IRS estimates of U.S. private wealth at $141 trillion. We've spent the effing money. Now, we saw this before in the decade of the 70s. We dealt with the fact that we weren't able to honor our obligations by inflating away the net present value of those obligations. We honored the nominal value of the obligations because according to the Congressional Budget Office and the Office of Management and Budget, the purchasing power of the US dollar over 10 years declined by 75%. Not coincidentally, the price of gold went from, admittedly, a price-controlled $35 to a high of $850. I believe past is prologue. I hope I'm wrong. But I don't understand arithmetically how the world's reserve currency doesn't experience a 7 or 8 or 10% compound decline in purchasing power for a long time. I believe an old codger like me will continue to get the promised benefit of Social Security. I don't know what they pay me, $4,000 a month. I think 10 years from now, they pay me $5,000 a month.
Right.
But I think that the purchasing power of that $5,000 will be the equivalent of what $1,000 is today. In other words, we'll honor the nominal obligation by inflating away the net present value of the aggregate obligation. And in circumstances like that, historically through time, gold has done extremely well.
Yeah. Okay. So there's a case to be made that the US dollar will devalue at a compounded rate of 7 to 10% per year on a go-forward basis. That case is, yes, the $34 trillion in debt, but the $100 trillion in off-balance sheet liabilities, which is effectively the $5,000 that you're going to receive in 10 years, right? These are committed expenses that we are locked into in the future. We just haven't realized those yet, but they're coming.
And by the way, Jay, I think the U.S. dollar will do well compared to other fiat currencies.
Yeah, right.
I joke that the U.S. dollar is the worst currency in the world with the sole exception of all the others.
Yeah.
I stole that from your speaker, Doug Casey.
Yeah. Right. Yeah. So that's it. When you say off balance sheet liabilities, that's what you're referring to, future committed expenses that we're probably not going to have. Yeah.
Medicare, Medicaid, Social Security, federal government pensions, military pensions, the Environmental Trust Fund, all of the promises that we have stipulated that we haven't funded.
So what's the parallel case then for gold, if there is one, to our thesis on copper and uranium, that effectively this is a long bet on human ingenuity and progress? That's what.
So is gold. When people work, when Jay Martin takes time away from his wife and kids and builds a business, he wants to increase his wealth. The case is human ingenuity. The case is, how do you protect the benefits of your hard work from the collective stupidity of the state? That's really what it is.
Yep.
It is human ingenuity. Gold is unique in that it's a store of value and a medium of exchange. Fiat currencies are merely mediums of exchange, subject to manipulation. I joke that the success of the United States has to do with the fact that we are still a society where 5 or 6 kids can take over a garage in Sunnyvale and out pops Google, or out pops Apple, or out Pop's Facebook. Against all odds, over 50 years in the United States, our individual creativity and initiative has funded our collective stupidity. Going forward, it's going to be a tougher fight. And I think that you protect yourself, you protect your productivity from the state by owning gold as opposed to owning long government bonds.
Yeah. I love that. I love that. It's the same bet. It's still human ingenuity and progress. If you're going to work hard and take risk and then you're going to watch your income at that 7% compounded devaluation rate, you're going to do something about it.
Defending yourself from the envy of your neighbors, sadly.
Defending your what?
Yourself from the envy of your neighbors.
Sure. Yeah. Okay. Rick, this has been an awesome conversation. I got to ask about silver. We haven't covered silver yet. Let's spend a quick minute on the silver sector. It's the it's the dual metal. You can go either direction with your thesis. What's your thoughts right now on the silver sector, Rick?
My experience is that it's very difficult to understand supply because it's a byproduct of other materials. It's very difficult to understand demand because so much silver is owned privately.
Oh, yeah.
You don't know where it's going to come from.
Sure.
So although I understand it, looking at it for 40 years, for 50 years, what I see is a circumstance where when the narrative is established by gold, when the generalist money comes in the precious metal space, silver, perhaps because of its lower unit price, rises further and faster.
Yeah.
Gold leads a silver bull market. Silver finishes a silver bull market. And the moves have historically been spectacular. I don't know why. I just know that. And it would appear that the most constrained subset is the higher quality silver juniors. The population of them is so small, the silo, if you will, so small, that when the generalist capital comes in the space, the silo can't contain the capital. I remember myself with some great pleasure the early part of the decade of the 90s. And I remember underwriting first Pan American silver at 50 cents with a full warrant and watching it go to $45. I remember underwriting silver standard at 78 cents with a full warrant, watching it go over $40. When I say that the upside in the small cap, high quality silver companies is spectacular, that's the sort of quantum I'm talking about. 5 year, 6 year, 7 year, 40-fold or 50-fold moves. Let's suppose it wasn't so good this time. Let's suppose you only got a 10-fold move. It's a pleasant circumstance to consider.
Yeah, it is. Yeah, it's that slingshot effect, isn't it? Smaller market, more volatile, trails gold, eventually sometimes rockets like that.
Correct.
Okay. I'm glad I asked. I appreciate that. Rick, you're going to be with us in Vancouver, January 19th and 20th, live on stage at the VRIC. If you guys want to meet Rick, come to the show. You can go to goodbyejustin.com and get your tickets today. And if you want to meet him, we're having a VIP party. So, general admission to this conference doesn't cost you anything. You do have to pre-register. You can't just show up, but you can register for free for general admission, and that gets you everything, all of the workshops, the speaker hall, the trade show. But if you want to join us at our keynote speaker cocktail party, pick up a VIP ticket, and that gets you, yes, front row seat to the speaker hall, all of your meals taken care of, but also the most coveted event at the conference, which is the keynote speakers cocktail party at D6 Lounge over at Park Casino. Super fun. Rick, I'm looking forward to having you there. So goodbyejustin.com for those tickets today. Check them out. And, Rick, where should I point people today? So you got a very unique program that you run where you actually rank people's portfolios. So they can elect to send you like their top 10 stocks that they're looking at. They have questions about.
Every resource stock they own.
They can do 100. Okay.
Yeah, they have to own them. I don't want people sending me a laundry list of shit they might want to buy.
Okay. All right. Yeah.
But, I mean, it goes like this. Go to Rule Investment Media. That's my website. List your natural resource stocks. Please no pot stocks, no tech stocks, no crypto. Leave an old man to do what he does well. Your natural resource stocks, I'll personally rank them 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues if I think my comments might have some value. ruleinvestmentmedia.com. List your natural resource stocks for free, no obligation. I'll rank them and email them back to you.
It's a solid offer. Yeah, everybody in this industry should take Rick up on that. And you should also come to Vancouver January 19th and 20th and hear Rick live on stage. I got you doing a lot. We're going to be on the copper panel together, the uranium panel together. You're doing a couple Q&As and delivering your own keynote speech, which I'm very excited about. So
I look forward to your toast at the speaker's dinner, bidding your prime minister adieu.
Right. Just wait. Yeah, me too. All right. Thanks so much, Rick. I appreciate your time.
Thank you, Jay.
All right.